Stop what you're doing right now. Seriously, if you own Capri Holdings, or you're even thinking about dipping your toes into the luxury sector, you need to hear this explainer. Wall Street is screaming that the Tapestry merger falling apart is an absolute disaster for Capri. But honestly, this might actually be the greatest thing to happen to their long-term shareholders in years.
See, last week I ran Capri through 5 fundamental valuation models and 2 legendary investor checklists, and what I found completely shocked me. Once you strip away the market noise and look purely at the cold, hard balance sheet, a totally different story emerges from what the headlines are screaming.
There is a massive disconnect happening out there right now. Everyone just sees a broken merger with Tapestry that collapsed back in November 2024 over regulatory and legal hurdles. But the reality on the ground? Capri just pocketed a cool $45 million reimbursement from Tapestry, and now they are forced to operate as a leaner, highly focused standalone company.
And consider this mind-blowing statistic. As a standalone company, Capri's return on equity just hit a staggering 83.3%. Let that sink in for a second. 83.3%. Yet despite that massive profitability metric, the stock is currently trading at a ridiculously low forward PE of under 9.
Look, I totally get it. The fear of catching a falling knife is incredibly real. It is absolutely terrifying for retail investors to watch a stock lose nearly 54% of its market cap in a single fiscal year. Watching your portfolio bleed red hurts, and it's so incredibly hard to buy when everyone else is panic selling.
But right now, investing in Capri Holdings is kind of like finding a vintage Michael Kors bag sitting in a thrift store. It's either a priceless, authentic hidden gem that just needs a little dusting off, or it's a damaged knockoff that's going to fall apart at the seams the second you put your wallet in it.
So the multi-million-dollar question we have to answer is this. Are you willing to buy the blood in the luxury streets, or is this the ultimate value trap waiting to happen? To find out, we're going to look at the numbers exactly how legendary investors Warren Buffett and Peter Lynch would, giving you a clear, actionable framework that you can literally steal for your own stock analysis. By the end of this explainer, you'll know with absolute clarity if Capri Holdings is a Buffett buy or a Lynch trap.
Okay, so let's dive into the timeline. To understand exactly where Capri is going, we have to look at what they just did. In November 2024, the Tapestry merger officially died. But then, in December 2025, management made a massive, highly strategic move. They sold the Versace brand to Prada. And looking at the raw fiscal 2026 numbers that ended in March, this one singular move significantly strengthened their balance sheet and actually allowed them to return to profitability.
The immediate financial impact of that Versace sale, it's pretty incredible. Their net debt absolutely plummeted. We're talking going from a heavy $1.4 billion all the way down to just $222 million post-sale. Plus, because they are no longer bleeding cash on underperforming segments, their overall gross margins actually expanded to a very healthy 64.8% in the fourth quarter of fiscal 2026.
All of this builds a massive, undeniable case for a turnaround. Think about it. In fiscal 2025, the company posted a super painful net loss of $1.18 billion. Fast forward to fiscal 2026, well, even with the slight drop in overall revenue, down to $3.47 billion, they actually generated $137 million in positive net income. They completely stopped the bleeding. And management is so confident in this cash generation right now that they just authorized a massive $200 million share repurchase program.
So we've got a company with plunging debt, returning to profitability, and aggressively buying back its own stock. But is that really enough? Does it pass the rigorous standards of the greatest investors of our time? Well, let's break out the scorecards and see.
First up, we really need to understand Capri's brand new business model. With the whole Versace distraction completely gone, Capri is aggressively focusing its energy on its 2 remaining core assets. They are laser-focused on returning Michael Kors to growth, aiming for $4 billion in long-term revenue. And at the same time, they're capitalizing on Jimmy Choo's momentum, which actually just saw a 5.3% revenue increase in the fourth quarter. It really is a tale of 2 fashion houses now.
Now, when we run the actual valuation numbers, it's a fascinating mixed bag. The incredibly low forward PE of 8.93 and a really strong 6.30% earnings yield are absolutely screaming deep value. Basically, it means the stock is remarkably cheap for the cash it generates. Now, to be fair, we do have to acknowledge the price to free cash flow is highly elevated at around 155, but that's largely reflecting the temporary restructuring and working capital shifts from the recent corporate shakeup.
So the absolutely crucial point is how all of this maps to the Warren Buffett checklist. Now, you know Buffett loves a strong brand moat, which Michael Kors and Jimmy Choo definitely still possess. He demands a high return on equity, and Capri's delivering an astronomical 83.3%. He loves expanding gross margins, which, as we saw, hit 64.8%. And maybe most importantly, Buffett loves a management team that uses excess cash to aggressively buy back undervalued stock, which Capri is doing to the tune of $200 million. So, on the Buffett scorecard, Capri is basically lighting up green across the board.
But what about the Peter Lynch scorecard? Lynch famously loved what he called turnarounds, companies fixing their broken balance sheets quietly, out of the spotlight. Well, the rapid debt reduction post-Versace, taking it down to just $222 million, perfectly fits Lynch's criteria. Furthermore, Capri decreased its overall inventory by 17% year over year. That is massive. It shows a business smartly right-sizing its operations, not just desperately stuffing the channel with unsold bags. Add in the positive earnings turnaround and the fact that Wall Street practically hates this stock right now, and you honestly have a classic Peter Lynch setup.
And the thing is, management isn't just resting on simply surviving fiscal 2026. They are looking forward. They are highly confident in this turnaround, projecting low single-digit revenue growth to hit about $3.525 billion for fiscal 2027. But here's the real kicker. They are projecting a massive 40% jump in adjusted earnings per share, taking it all the way up to $2.15. If they actually hit that EPS target, that forward PE of under 9 is going to look like the absolute steal of the decade.
Even CEO John Idle is openly calling his shot here, stating that with a strengthened foundation, these two iconic fashion houses are well-positioned to deliver serious, sustainable, long-term shareholder value. The bloated, highly complicated era of Capri Holdings is over, guys. The lean, margin-focused era has officially begun.
So, when you add it all up, the massively eliminated debt, the wildly high return on equity, the strategic share buybacks, and the ruthless Buffett-Lynch metrics, they all point to one definitive answer. The underlying math strongly suggests this isn't a value trap, it's a deeply discounted turnaround play. So the question I want to leave you with today is this. Knowing what the fundamental numbers say, are you stepping in to buy the blood in the luxury streets before the rest of Wall Street catches on? Let that simmer. Thanks for joining me on this explainer, and I'll catch you in the next one.